What's up, YouTube? It's Joe Ketchpalia sitting on the couch making some money investing in fractional real estate online, as usual. If in case you haven't been paying attention and you are investing on Arrive secondary market, they have the next opening starts in 2 days, 6 hours, 42 minutes, and 48 seconds. By the time you're watching this, I'm sure it's going to be even sooner. So don't take this as real time because obviously this is a recording. One of the things that I think is interesting, this is going to be, I think, their largest secondary market offering so far. There's going to be 454 properties. At least that's what they've got loaded into here at the moment. That's about double what we've seen in the past. We've seen, around 200 and change. And one of the things I've seen recently is that eventually, and I don't know if this is starting this month or not, but they're going to try to have every property that's available up for 1 week every single month. I don't know if this is, just a step towards them having just open markets regularly or not, but I thought that's kind of interesting that they went from, trying to do once a quarter to it seems like we're already going to have once a month. If you haven't watched my other videos on how I go through and look for stuff, it's tough to tackle so many deals in a short period of time and really understand which ones you want. So, that's why I'm doing this video a couple of days early so that if anybody is looking at these, you can jump on them. Now, one of the things I wanted to point out is, why I'm interested in the secondary market when I don't buy things on Arrived in general, in case you haven't seen this. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. Please do your own due diligence on those links. Some of them are affiliate links. Some of them will give you, or some sort of referral bonus. But you want to make sure you understand the terms of service. Sometimes you have to make a certain investment by a certain period of time in order to get that. Also, do your own due diligence on the platforms and the properties themselves, right? Just because I'm investing on them or in some of these properties doesn't mean it's a good deal for you. It doesn't even mean it's a good deal for me, right? I could be making a mistake. And also, in the description of this video, there's a link to a Discord channel I set up where we talk about all different fractional real estate platforms. There's a couple hundred of us at this point. Most people are lurking, but plenty of people are now participating, sharing due diligence info, strategies, all that sort of thing. If you join, there is no cost. It's not a sales funnel. I don't DM you to try to sell you anything. If you get DMs from someone who looks like me, please report them. There are a couple of scammers. They've been kicked from our server, but still somehow figure out when people join. Anyway, please feel free to join that and, be an active member of the community, sharing info when you can and asking questions if you're just getting started. Okay, so, in general, I'm not a big fan of Arrive. Like if we look at, one of their most recent offerings, this is I think it's called, the Caldwell. You can see, looking at their financials tab, their stated annual cash flow is 3.6% yield. It's a pretty low yield, and they're just assuming that you're going to make a lot, a decent chunk of your return on annual appreciation. You can see here 5.4% total annualized returns is what they're projecting. I get all their emails because I'm an investor on there now. And they sent out, they were all excited that this one that is a current offering actually rented for $175 per month more than they had projected. And so this one is, their annual cash flow is 4.1%. That's their projection. But that's with this rate is taking into account that new higher rate. So, even with even outperforming what they originally thought, this is going to have an incredibly low yield, right? Like I've been pretty critical of yields on a lot of different platforms, and I just, 4% is really hard for me to deal with. Now, I know what you're thinking, well, didn't you just buy something with a lower percent on ARC 7? I'm going to talk to you about that in a minute. I've got that tab open, but when that's their projection and that, they might even miss them. Some of the platforms do miss their projections. Is that even enough to get excited about, right? Why would I invest in something where, if things work out the way I'm expecting, I'm only going to get 6.2%, and that's including the appreciation. It's just really hard for me to get on board with that. But when properties show up on their secondary market, and I can buy them at a big discount to the real world value, that's when this starts to get exciting. And, are there going to be discounts this time? I'm sure that there are. One of the things that will be interesting to see, every time this has happened so far, there have been the opportunity to pick properties up at a discount. As the secondary market becomes more popular, it's going to be interesting to see if those discounts get bigger or if they're not, right? Like if they get smaller. These deals, they just don't really work well for me. They're just not hitting the types of returns that I want to get to invest in something that's just not a traditional, safer investment. I mean, it is real estate, but it is real estate, packaged in a way that we just haven't really seen before some of these platforms. And so I want to get paid above average returns for taking the additional risk of buying something that is, new and really untested. And it just doesn't seem like we get that when we invest, for their stated returns. But when we get something, I bought a few in the last cycle, and if you get them for a 10 or 15 or 20% discount from what you think the real world value is, well, then we have something, right? Because then we have the potential, that return is unlocked when the property sells. But then on top of that, you get a higher yield because you paid less than their IPO price. So that's where I think things start to get interesting. If you remember, I mentioned this site a while back, Tyrios. This is it's sort of the same idea, but they've just picked one market. They're in like the San Marcos, which is just south of why can't I get this to open? Which is just south of Austin. And I was like, I was thinking about investing in this, even though they have incredibly low yields that they're projecting, right? Like this expected dividend rate, $3.25 per $100 invested. That's a 3.25% yield. And actually, we see it go down in future years. I had mentioned, I just really like that market. I think that properties are going to do well long term here, which got me thinking about investing in this. But at the end of the day, I decided against it because, it is just way too low for stated yields. And so I mentioned, I just bought something on ARC7. That's partially what got me looking at some of these deals on ARC7 that have lower yields, but are in, like this one is incredibly low, right? 2.68% dividend yield. But again, it's a market that I'm a big fan of Austin. I think that, long term, it's going to continue to do well, even though we've seen a decline in recent years. I think that decline only came from you had just extreme price and rent increases, during the post-COVID time period. And once interest rates went up and once a lot of people, all the back to work stuff happened, a lot of people who had moved to Austin and were working remotely went back. But I think the long-term trend is still going to be growth there. But another reason that I like it, and I've mentioned this a few times recently, is all of the markets that I don't have MLS coverage, I feel like I don't have all the data I want to make a good decision. This particular part of Austin does fall within one of the MLSs that I'm a part of, and so I get to see, last time this went up for rent, how long it took to rent, and it was only a couple weeks, which is, pretty fast and, at a good rate. Obviously not a good rate relative to the price. That's why you have such a low yield. But also, because I have that access, I feel really good understanding where I think the value is. And, when I picked this up, it was a huge discount to their IPO price. I'm actually not even sure. I want to say I can look at my portfolio and I think I can see it there. That's one of the things, they show you the discount, 27% discount from the IPO. Let's see. And I just actually had a couple more close today, so my blended rate, let's see, 981, but how many shares do I actually have? 45 shares. Yeah, my average cost $21.80. I don't remember what this started at, because I think it was a weird number. Well, I think when I was doing the math on it, it wasn't a very. I don't think it started at 25. Let me go back to that page. It seems like they used to have their IPO number in a spot that was like really obvious, and lately I have been struggling when I'm trying to find it, and I'm not sure why. I don't know if they just have been hiding it. Let's see. Anyway, it's not really that important, because the discount to their IPO isn't what I care about, right? What I actually am looking for is a discount to the real world value. And when I picked up this one, at $21.80, we can multiply that by the total outstanding shares, right? Which is 20,890. I was doing math on that other end, so 2,890 times 2180, 455,402. You can see, that's significantly below this market cap here. Well, I don't understand why, actually, because I thought this market cap is the last traded value. Maybe it's maybe that's at the available value. Let's look. Trying to figure this out together in real time. Isn't this exciting? So the available is $25 times 20890. Yeah, so that's how you get to this. That's how they get to this number, right? But so you could see, I picked it up at like $70,000 below that value. When I was doing, let's see what Zillow says about this, because I actually didn't think that Zillow. I'm not going to share the MLS data, because I think that I'm not supposed to be in this particular one. They all have slightly different rules of what I can post. Yeah, so that's right on this estimate, right? That 25. It's actually, this is a little bit below this estimate. I actually thought that it seemed like you could sell it for even a little bit more than this, and so I feel like I'm getting a really good discount to the real world value. Now that only helps me someday in the future when this property sells, but at the same time, by getting it at a discount, that gives me sort of additional leverage on the appreciation side, because even though I paid around $455, the 522, if that's the real value, or the 527, that's the number that's going to get impacted by annual appreciation over time, right? And so I'm getting that additional benefit there. Even though, which is one of the reasons that I picked this one up, even though it has incredibly low yield, right? So it's kind of like sitting in between where I'm buying super discounted properties on Lofty, and I expect to be able to flip those pretty quickly. But I see the risk level much different there, right? I see it as there's a lot more things that could go wrong, where here it's at least, the asset management is being done by a team that I think are going to be making quasi-intelligent decisions versus just sort of the masses, making votes, and who knows what they're going to do when we're over there on Lofty. So it is, I think, I don't need as large of a return on ARC 7 to be happy, because I think on a risk-adjusted basis, there are less things that can go wrong, especially because buying this, it's a market, like I said, where I have a lot more clarity and data. It is a long-term rental, and like last time, it rented extremely quickly. I think that's a good sign. It's a higher-end property, right? It's not like, as much as I like that. Oh, come on, this is not loading. Let's see. It's not this home from Lennar. As much as I think Lennar puts out products that are good for entry-level owners and also entry-level investors, and some of the only products where you can buy new builds and still make it work as a rental. I don't believe that this property is going to experience the same, long-term value appreciation as one like this, right? I think that they're different neighborhoods. It's, there's definitely a different value proposition for people buying these. I would assume, and I don't know this for sure, that you're going to have a much higher percent of owner occupants in this neighborhood than you're going to have in the other. So for a lot of reasons, like this is a very long-term hold appreciation play versus on Lofty. I'm really looking at those more as flips. And, on Mogul, that's where I'm still also looking on long-term holds, but current yield is more important on there, right? And then I have ground floor, which is loans, but even higher yields. But again, so I'm trying to construct this, I have a nice spectrum of deals, and I'm not always looking for the same thing on each platform, which is why sometimes, I think that it might sound crazy when I'm like, oh, well, look at this. I'm never going to buy this deal because, they're saying their stated appreciations or their stated annual cash flow is 4.1%. And then I turn around and buy this one and it's 2.68%. And actually my yield will be a little bit higher because it's at, I paid a lower price, but still definitely below that 4.1, right? So I sound like a crazy person, like, oh, I would never buy that. And then I go and buy this. And so I felt like trying to explain that a little bit more. It's based on having different goals, it's seeing them as a different level of risk, and also just having more insight into one deal than another. Sometimes I'm willing to get paid a little bit less if I have more certainty around that return. And so that's what is going on here. But also through getting paid less on a current basis. But I do believe that this is, it's a market that should perform well in the long run, and combining that with a deep discount from at the purchase, I do expect to get good returns on this one, just in a different way. Anyway, that's all I've got to share about that. If you're excited about the Arrive secondary market coming up, I'd love to hear about it. If you have certain properties that you're targeting, that's one of the things that maybe we don't, I understand if you don't want to share that as much, right? Because we are going to be competing to buy some of these deals. I think we're going to see, hopefully soon, some new resources to sort of analyze these. But if you have a different way of looking at their secondary market, if you're been attacking your due diligence in a way that you think is helpful and you want to share, please do that. Anyway, that's it. That's all I've got for today. Until next time, I'm going to just keep making mistakes so that you don't have to.